Today, we're diving into a topic that might not sound as exciting as compounding or asset allocation, but trust me, is just as crucial for your long-term wealth. We're going to talk about something called investment fees and how they can have a huge impact on your money over time. Just to quickly recap from our previous lessons, we know that investing is essential. It's how your money works for you, growing over time and staying ahead of inflation. We also talk about asset allocation, which is essentially your game plan for how you spread your investments over different types of assets, like stocks and bonds. That strategy sets the stage for your growth. But here's the thing, that growth isn't free. There are some costs involved in the investing world. So what exactly are these costs? We call them investment fees. These are charges that come with managing your investments and your investment accounts. These fees are deducted directly from your investment returns. That means they reduce the actual money you get to keep. Now, they might seem small at first, just a tiny percentage, but as we'll see, even those small fees can really add up, especially over the many years you'll be saving for retirement. The most common fee you'll encounter, especially if you're investing in a mutual fund or ETF, which are very popular for retirement savings, is called the expense ratio. Think of this as the annual operating costs of the fund. Its charge has a small percentage of the total money you have invested in that particular fund. This percentage covers all the behind the scenes work, the fund management, administrative costs, legal fees, and so on. Let's look at an example. If a fund has an expense ratio of 0.5%, that means for every $1,000 you have invested in that fund, you are paying $5 per year in fees. $5 might not sound like much, right? But remember, this is an annual fee, and it's a percentage of your total investment, which hopefully will be growing a lot over time. While the expense ratio is usually the big one to watch out for, there are a few other potential fees that you might come across. For example, trading costs or commissions. In the past, you often had to pay a fee every time you buy or sell a stock or ETF. Well, the good news is many major brokerages now offer commission-free trading. Another fee will be the account maintenance fee. Some brokerages might charge a small fee just to maintain your account, especially if it falls below a certain balance. However, with larger brokerages, these are becoming less common, or they are waived if you meet certain requirements. For an example, signing up for e-delivery may be a way to reduce or eliminate fees. And finally, there's also the advisor fee. If you choose to hire a financial advisor to manage your investments for you, they would charge a fee for their services. This is usually a percentage of assets they manage for you, or sometimes they charge a flat fee. This can be a valuable service, but it's another layer of fees that you need to be aware of. For this lesson, we will be focusing on the expense ratio fees. All right, this is the slide where we really see why these seemingly small fees matter. This table illustrates the power of compounding, but in reverse. It shows how much money you could have at retirement. starting with the same initial investments and making the same regular contributions, but with different levels of fees. And we can see here the different fees. So we have investor one, that 0.1%, then investor two invested at 0.5%, and investor three invested at not point, but 1%. And over time, you can see the difference in the amount of money that they would have saved. So we start off with $20,000 a year, 20,000, and we invested $15,000 per year. So we have all the people were getting 8% annual rate of return, which is a pretty good return. And we can see their total contributions, but then at the end of investments, we can see investor one got almost 1.9 million, investor two 1.8, investor three 1.6 something million dollars. So we're talking about a $300,000 difference by just looking at this feed structure. Imagine your investment funds perform really well and earn a gross return on average of 8% a year, which is fantastic. But if that fund had a 0.5% expense ratio, that 0.5% is subtracted before you even see your returns. So actually, your net return for that year will be 7.5%. Now, 0.5% might not seem like a lot in 1 year, but that difference compounds. Next year, you'll be earning 7.5% again, but on a slightly smaller amount. And year after year, that continues so on. So over decades, this seemingly tiny annual subtraction turns into a massive sum of lost wealth. It's like a small leak in a boat. Over a long journey, even a small leak can sink it. This chart on this slide really gives you a visualization of these different amounts. So, how do you find out what fees you are paying or would be paying for your investments? It's easier than you might think once you know where to look. One place to look is in the fund prospectus or a summary prospectus. Every mutual fund or ETF has a legal document. You can always find this online on the fund company's website. Often there are more digestible summary prospectuses too. Another way is to look for a fact sheet for that particular fund or ETFs. And this will give you an overview of the expenses and will also clearly state the expense ratio. Now, another place to go would be your employer retirement plan documents or websites. If you're investing through a 401k or similar plan at work, your plan administrator like Fidelity, Vanguard, or Empower or whatever will also have documents or a website where you can find this particular information. Or you could just go into websites. There are many websites that post the funds and ETFs information. These sites list the fees and other important information. Such sites as Google Finance, Morningstar, Yahoo Finance, etc. will post the information on these funds. But here is an important note. When viewing mutual funds performance percentages, like over 1 year, 5 years, 10 years, the gains typically include the expense ratio. So the expense ratio is deducted from the fund returns before the performance is calculated and reported. So don't be afraid to dig in for this information. It's your money and you have a right to know what you are paying. So when you're doing your research, what is considered a low fee? For broad market index funds like those tracking the S&P 500 or the total US stock market, an expense ratio below 0.2% is considered good. Some funds even go as low as 0.03%. However, for target date funds, which automatically adjust your asset allocation as you get closer to retirement, the fees might be slightly higher because they are essentially a fund of funds and offer the convenience of this adjustment. But even then, you still want them to be competitive, perhaps in the 0.2% to 0.4% range for good options. Just know what you're paying and compare it to what is other similar options. There are two popular types of investment funds: actively managed funds, also referred to as active investing. Then we have index funds, which can be referred to as passive investing. We'll be talking about both of these types. Actively managed funds often employ highly paid professional investors, fund managers, whose job is to decide the best stocks to buy and sell. Their goal is to beat the market. They aim for their funds to perform better than a relative market benchmark, such as the S&P 500, that aligns with their fund investment strategy. Fund managers conduct research, analyze company financials, and make predictions about the economy. Index funds are designed to track an index rather than having managers constantly buying and selling specific stocks. Because of this, they typically have lower expense ratios when compared to actively managed funds. Think of it like buying a pre-made basket of an entire grocery store, most popular items. Less cost, less effort. In the long run, index funds, in the majority of times, will outperform actively managed funds. Why is that? Well, fees. Fees significantly impact your long-term wealth due to compounding. Understand the fees you are paying and choose low-cost options when available. While active funds sound appealing, index funds offer a powerful, low-cost, and historically effective way to participate in the stock market's long-term growth. Studies after studies show that over a period of 10 to 20 years, a significant majority, like over 80% of actively managed funds, fail to outperform their benchmark index funds after fees. To wrap it all up, the core message is that fees, which includes expense ratios, are a huge deal for your long-term wealth because of the magic of compounding. That same compounding force that makes your money grow also makes fees erode your money. Whenever possible, choose low-cost investment options. This simple act can add thousands of dollars to your retirement nest egg over your lifetime. It's truly one of the easiest wins in investing. However, some employer retirement plans have limited options. Therefore, it's important to understand what fees you have for these funds and what's available in your plan. I would like you to find expense ratios for your investment options that are available to you in your retirement accounts. Compare them and understand what you're paying. So, for your action step, I want you to empower yourselves. Go find the expense ratio and any fees for the investment options available to you in your own retirement accounts, whether that's a 401k through work or an IRA that you set up. Look up those numbers, compare them, and really understand what you are paying. You'll likely be surprised by how much difference even a small percentage point can make. You're taking charge of your financial future, and understanding fees is a massive step in that direction.